There's a perception, a legitimate perception right now that there's an oversupply, overbuilding. And if you look at March 2016 compared to 2015, new construction's up almost 22%. Demand, the good point of it is demand is also up and forecasted to be up in 16 and 17, just at a slower rate. I think that the toughest sledding will be in new construction. There's going to be tougher underwriting. There will be lower LTVs. There's probably a guarantee in there somewhere, either a construction completion guarantee or a personal guarantee. And it's just going to be probably primary and secondary markets primarily. The good news is that the right project with the right location, a strong sponsor, and proven management is going to find financing. It's out there, and most likely in that scenario from a regional bank.
Well, right now we're in a actually a very unsteady market, with perceptions being all over the board. So as a consequence, there is financing out there, but it's very tough to get. You have to have a really good story, good background, good team, and so on.
You know, I think post the economic crash that we all went through, a lot of healing went on in the market, and sort of underwriting came into a sense of normalcy as it relates to the amount of equity required and the people bringing debt to the market. You know, the wobble in U.S. equities the last 12, 15 months has caused some tightening, also some of the global slowdown in growth in China. So I just think there's still financing out there. Interestingly enough, quite a few of our franchisees have started to interact quite a bit with the SBA and start to go back down that road as a lender that's still active in the market. And a lot of people using brokers again, just because you do have to cast a wider net in order to get it. But I have not heard that projects are not being done due to financing. Just the lead time's a little bit longer. You know, they're going to do we're back to tighter underwriting, which is probably healthy for the market. Equity requirements are up a bit, and you know, there's a little bit of extra scrubbing of the markets. We've seen a bit of a slowdown in the Houston and sort of the energy states and the border states with Canada as the oil prices have changed. But we have not picked up that you can't get it done. It's just taking a bit longer, and it's a bit more costly.
From the equity perspective, there's more competition. At this point, we have investors who are not just looking at hotels as a potential investment, but are also looking at other asset classes. So we're seeing that being more competitive as we look at return requirements for deals. From the lender perspective, it's a matter of getting enough proceeds from a loan to really cover and generate enough of an equity return for what is becoming higher risk investments at this point in the cycle.